Okay, I just want to take a minute while I have the podium to thank everyone who made this conference possible, who made it happen. As you all know, there's always a ton of work behind the scenes. So I want to, first of all, thank Jan Eberly, who contributed in many ways. She co-organized the conference with me, and also together with Jonathan Parker and Antoinette Shore, served on the program committee and helped select the great papers we've all learned so much from today. And I also want to say we got a lot of submissions, so that was really nice to see. The funding for the conference was provided by the Golub Center's generous supporters. And then I especially want to thank Deirdre Wade and the large team that she assembled for all the work that went into taking care of everything logistical that made this fun and possible. So thanks to all of them. Deirdre, okay. And now it is my great pleasure to introduce today's keynote speaker, Professor John Campbell, who's the Morton and Carol Ocean Professor of Economics at Harvard, where he's been there as a distinguished member of the faculty since 1994 and at Princeton before that. I think you all know him, but I'll just make a few remarks, which is Professor Campbell has a remarkable publication record, spans macroeconomics, asset pricing, portfolio choice, and of course, relevant to today, household finance. I'm always kind of knocked over by what he does. He has this rare gift of being able to identify and elegantly solve important and difficult technical problems. And then he can turn around and communicate very sophisticated economic ideas simply and clearly. So I know that, just as one anecdote, his textbook, Financial Decisions and Markets, A Course in Asset Pricing, is the mainstay at MIT of how we teach asset pricing to our PhD students. So appreciate all of that. So throughout his career, John's received numerous honors, too many to enumerate here, so I won't even try, but his CV is a pretty inspiring read. And beyond academia, John is co-founder and board member of Arrow Street Capital, a Boston-based quantitative asset management firm. So we're honored to have Professor Campbell here with us today. His newest book that he's going to talk about offers some answers to, I think, a big question that's come up repeatedly at this conference, which is inequality in personal finance, and what should we do about it? So please join me in welcoming John Campbell.
Well, thank you very much, Debbie, for that kind introduction and for giving me the chance to promote a book that I've been writing with a friend, former student, recent co-author, Tarun Ramadharai, who teaches at Imperial College London. And the book has a one-word title, Fixed, and then the subtitle is Inequality in Personal Finance and What We Should Do About It. Now, Debbie said nice things about my earlier textbook, but my family for years has complained that I've never ever written anything they can read, and my books are all full of equations, and there's been some complaints. So I thought I would try to write a book for a general audience, and this is my first attempt. So of course the level of the book is way below what this audience deserves. So I think the interest for you is likely just to be in the framing that we attempt and whether you like the framing. But this is a book with no math, no tables. There's some figures. Just for fun, I've inserted some of the figures in the slides as we go along to give you the idea. It's a book that's full of endnotes which refer to the academic literature and which readers like you might be more interested in. But I think most people who read the book will ignore the endnotes and just read a verbal argument. I should say, before I start, that the book has a global perspective because the problems of personal finance, we think, are surprisingly similar around the world, and also because each country can benefit from looking around the world and trying to identify global best practices and systems that work better than others, or alternatively try to avoid the worst things. So we feel the global perspective helps, although it does make the book harder to read, because, or harder to write, I should say, because we cannot take for granted even the basic finance terminology that's used in one country may differ from another, and certainly the systems differ a lot. So it makes the task of sort of reconciling the big picture and the details a little bit more complicated. Okay, so can I have the slides? Yeah. All right, so what's the purpose of the book? Well, first of all, what does the title mean? Why did we call it fixed? Originally we thought of a really emotive word like rigged, and then we realized that actually, if you go to Amazon.com and you put in rigged, you get about 10 books with that in the title, including one about the LIBOR fixing scandal, which made quite an impact in the UK financial community. So we thought we'd say fixed, and it refers to both, what we think the current state of the personal finance system is, which is that it benefits financially sophisticated people, whether they're operating the system or simply using it, at the expense of less sophisticated people. But also, it's supposed to be a weak pun. It should also refer to the possibility that we can repair this situation. We'd like to be technocrats who roll up our sleeves and try to do something about it. Now, the book is very much not a self-help guide. We're not trying to compete with the financial gurus or finfluencers. This is not Dave Ramsey. We don't think we could compete with those people, and that's not our purpose, although I think readers of the book will get quite a bit of useful advice, wisdom, sort of along the way as a side product. The focus is instead on the financial system and how it could be reformed. I should say that some people react to the problems of personal finance by saying the solution is financial education. And we're all for financial education. That's sort of the business we're in, actually. I'm teaching personal finance to Harvard undergrads these days. And we support the worldwide movement towards financial literacy education, the work that people like Anna Lusardi at Stanford is doing. But we don't think it's realistic for financial education alone to solve the problem. So the complexity of personal finance as it exists today and the rate of innovation, the invention of new complexities is going to outrun any realistic provision of financial education. So I thought, what I would do is sort of run through this book and just sort of indicate what's in it. I suppose before I do that, I should say we've just sent the final manuscript to Princeton University Press. The board of the press has approved it, so I can call it forthcoming. But it'll take them an amazingly long time to produce the book, so it won't actually be out until probably next summer. But anyway, it is in process. So here's the outline. We divide the book into 3 parts. The first part is kind of an overview of the problem at a high level. The second part is a series of chapters that go into details of specific parts of the financial system, trying to talk in much more detail about what's going wrong. And then part 3 is our attempt at a solution. Okay, so I'm going to just, in a very boring way, run you through the whole structure of the book with a couple of slides for each. I'm going to spend a bit more time on part 1 and part 3 and less on part 2, just because one could easily get bogged down there. All right, so what's in part 1? 3 chapters. The first one is sort of defining what we're talking about and indicating that this is a global problem on a large scale. Chapter 2 is about why people find financial decisions so difficult. A lot of the content there is behavioral finance, which will be very familiar to people in this room. And then chapter 3 is about the impact of the financial mistakes that emerge from chapter 2 on the, if you like, the I/O of the financial industry. We're doing very very amateurish I.O., very hand-waving I.O., but we want to argue that the presence of financial mistakes corrupts capitalism in a way that creates exploitation of mistakes rather than correction of mistakes, rent-seeking behavior, and so forth. All right, so let me flesh that out. So what's in chapter 1? We're arguing that the problems of personal finance have grown in magnitude in various ways. That's partly because of changes in society and the economy. People are living longer, they live in smaller families, they're not, older people have to fund retirement more for themselves rather than living with younger relatives, that kind of thing. They have to, early in life, you have to pay for higher education, which is more and more expensive. In emerging countries, you may have to pay for secondary education. There's a global trend towards urbanization, which means that housing has become more expensive, which worsens the financial challenges. And then the big picture globally is the growth of the global middle class. And there's the first figure in the book is this world income distribution charts. The top panel there is 1975, and the bottom panel is 2015. And the different colors correspond to different regions of the world. The red is Africa. The yellow is the Americas. The red is Asia. The blue is Africa. Green is Europe, and red is the Americas. And you can see the way in 1975 you had this huge poor population in Asia. You had a bimodal distribution of world income. And the era of globalization has shifted things to the right. We have a single hump, and there's an enormous world population that has moved out of the region to the left of the poverty line. The conventional poverty line is a vertical line in the figure, and into an income range where people may be poor by the standards of US expectations, but they're rich enough to be using a financial system, to be dealing for the first time with personal finance products. So in countries like India, people are getting mortgages, they're getting formal credit, and they're saving and so forth. And so there are a lot of new people confronting these problems for the first time. Then in the chapter, we also argue that personal finance contributes to wealth inequality through several channels. Richer people tend to earn higher returns on average. They tend to borrow more cheaply, and they also save more. And we illustrate that using a figure based on work by Bach, Calvé, and Sodini using Swedish data, where what they did was they sorted households by wealth on the horizontal axis, and then they calculated average returns on invested assets is the red line, the average cost of borrowing is the gray line, and the implied net return on wealth is the blue line. And you can see the way that the cost of borrowing slopes down, the asset returns slope up, and therefore the net return increases strongly with your position in the wealth distribution. And of course, there are some fundamental reasons for that can't be wished away. There are fixed costs of financial service provision, so of course that's going to lower the proportional returns to smaller accounts or the proportional cost of smaller debts. Rich people borrow more cheaply in part because they have collateral. Secured borrowing is more cheap. There are some very good fundamental reasons for this. But there are also, we argue, there's also the point that poorer people are more prone to trip up in the complex personal finance system. They may take out high-cost payday loans, or they may put their money in checking accounts that pay zero as opposed to a money market fund, contributing to the deposit franchise of the banks. Or they may buy high-cost, high-fee active mutual funds, or they may simply not participate in equity markets at all, so they don't earn the equity premium. All of these behaviors are contributing to this inequality of returns and borrowing costs, which then we show with a little numerical example in the chapter can compound over time and really contribute to the growth of wealth inequality. Okay, so if mistakes are important, why are people making mistakes? Why is it so difficult to make these financial decisions? And why do we worry about finance more than other fields? I mean, finance is inherently difficult. It involves time and uncertainty. Those are hard things for people to think about. There's asymmetric information. Even something that we in this room take for granted, like efficient markets logic, is very hard for people to grasp. Why? Because to really get it, you have to understand what others are doing and the equilibrium impact of what others are doing on prices. That is not intuitive. You practically need an economics PhD to get that. So finance is inherently difficult, but most people know very little about it. Financial illiteracy is widespread. So in this chapter, we have some figures based on the National Financial Capability Study in the US, showing the fraction of people who get very low scores on very simple financial literacy tests. The blue bars there are men, the red bars are women. The younger people are at the left, older people are at the right. You can see that particularly among young people and particularly among women, there's a lot of really shocking degree of financial illiteracy. And then there's also the phenomenon of overconfidence, which of course is a well-known psychological bias, but it's illustrated in the figure by the dark regions of the bars. The dark regions of the bars, those are the financially illiterate people who do really badly on the objective test, who also say in the survey, I'm very confident of my abilities to manage my money. And you can see that among the people with low literacy, it's older men who are amazingly overconfident. Now, financial education is certainly worthwhile, but for a number of reasons, we don't think it's ever going to be an adequate solution. There's a movement, a growing movement for states to require financial education in high school. California just did that, which is a big thing. I think it's up to 29 states now that do this. That's fine. The problem, I think, is that it comes very early in life, before high school kids have to make most of the decisions that maybe they're confronting a few initial things like taking on student debt if they're going to college. But too often, I think, high school financial education, it feels like a driver's ed would feel if there were no road component and it were just the classroom piece. Also, to really teach financial literacy well, you need math literate teachers, and they are a very scarce resource in high schools. Now, college financial education is a good thing, I think, and there's a movement to offer it, but of course it's helping people who are likely to end up in the top third or so of the population anyway. And then rapid change in the financial system depreciates sort of basic financial knowledge as opposed to conceptual knowledge. Okay, so regardless of how much financial education people have or don't have, they tend to rely on their intuition to make financial decisions. But this is where behavioral finance comes in. On the cognitive side, there's a lot of evidence that human intuition fails in financial situations. We tend to anchor our intuitions on familiar numbers, and if the numbers are unfamiliar, our intuitive judgments of scale are thrown off. Human beings struggle to comprehend exponential growth. That's something that every financial planner knows when they talk to clients. We tend to extrapolate from small samples. We rely on our personal experience as opposed to the complete financial history that's available. And there's this well-known phenomenon of base rate neglect when judging conditional probabilities. So we run rather quickly and briefly through the familiar list of behavioral biases from that literature. Then we talk a little bit about why a simpler approach of reinforcement learning fails. I mean, in many contexts, we just try things out, and then we repeat the things that felt good or that worked out, and we avoid the things that You know, if we touch the hot stove as a toddler, we don't do it again. But that doesn't work well in finance because outcomes are delayed and uncertain. And of course, people also tend to confuse luck and skill. And this is the so-called biased self-attribution. So if you do well with a financial strategy, you come to believe you're very skillful, and you repeat what may be a foolish gamble. Social learning is also important, of course. Many people learn from others. But in the financial context, there are correlated shocks. So, you know, in a house price boom, all the homeowners you talk to are going to say, this is great, come on in, you know, lever up and start flipping houses. That works well until the bust comes. So a large cross-section of experiences is not helpful in that context. And of course, people don't talk honestly about money. They tend to boast about successes rather than admit to failures. So that's all cognitive biases, but we also talk about temptation, or so-called present bias, and the challenge of doing the right thing even if you know what it is. This came up this morning. Saving is not fun. Sports betting is fun. Present bias will tend to, or just extreme impatience will tend to make you do the fun thing rather than face the long run. And as a sort of overview formulation, you know, in layman's terms, we argue that at the end of the day, a lot of personal finance looks as if people are ignoring their financial circumstances most of the time. They only make decisions very intermittently. That's the sort of Calvo financial attention type models. But then also when they do make a decision, they sometimes do it emotionally. So the stock market falls, you haven't been paying attention, all of a sudden you panic, you sell everything. And that's a pattern that we see in a number of contexts. Okay, so now what does this do to the financial industry? So again, remember, we're doing this for a general audience, so there's a lot of hand-waving here. But we argue that there are four important categories of financial mistakes. One is not understanding the benefits of a product. Another is not understanding the costs of the product, hidden costs. A third is failure to search, and a fourth is mismanaging the products after you've bought them. And the first two mistakes have a very direct corrupting effect, because capitalists, of course, supply what's demanded, not what would objectively serve customers' interests. And they are going to try to lower perceived costs rather than actual costs. If they can hide costs, they will do that. We make an analogy with unregulated medicine, you know, the sort of provision of snake oil before the modern system of financial regulation. The medical market, the pharmaceutical market of those days, was responding to the demands that people had or could be manipulated to have through advertising, but it was not promoting health. So society responded by putting in place a fairly onerous system of medical regulation. And we argue that some of the same things are going on in finance, and we should consider whether some move in the direction of the way we handle medicine could be appropriate for finance. Now, the failure to search, the third mistake, gives financial firms market power. But we think the appropriate I/O model is the old Salop model from the mid-1970s of firms that are competing with one another. You know, it's a model on a circle, and they compete, and you get entry, rent-seeking free entry, and what it does is it raises costs. So you get far too many bank branches. Every time I walk down the main street of Lexington where I live, I sort of grit my teeth as I see the empty bank branches, which are, I think, wasteful rent-seeking competition. Or think about the number of realtors we have. Financial firms also like to create complex products and bundled products, which make comparison shopping harder. That tends to enhance market power. And it's a very striking phenomenon worldwide that you see bundling. Then finally, what about product mismanagement, sort of messing up after you've bought a product? That leads to all kinds of cross-subsidies, some of which have have come up already this morning. So, people who are not keeping an eye on their bank account balance and pay high overdraft fees, that helps banks to offer free checking accounts. So people who don't overdraft end up getting cheaper banking services. Similarly, the late payment fees on credit cards help to subsidize card rewards. There's a recent IMF paper by Sumit Agarwal and co-authors that documents that. This morning, Paul Willan mentioned his work with Chris Girardi and David Zhang about how Black and Hispanic mortgage borrowers pay higher rates because they refinance slowly. Those cash flows help to lower ex-ante mortgage rates, so white borrowers pay less because Black and Hispanic borrowers are paying more. And then another example I like, a lead article in the AER a couple of years ago by Gottlieb and Smetters talked about the lapsing of life insurance. Life insurance, given the fairly flat premium path, is a bad deal early on and a good deal later. So if you lapse, you're creating a lot of additional revenue for the life insurance companies, and that helps to lower insurance rates, insurance premiums ex ante. We talk about how naive people are about conflicts of interest. We cite a study in the EU which showed that 40% of Europeans who buy financial products were completely unaware of any payments, of commission-type payments being made to salespeople, brokers, insurance salesmen, etc. So it's pretty easy for financial professionals to take advantage. But when people do figure it out, they become angry and mistrustful. And think of the slogan, Occupy Wall Street, is partly driven by these sorts of problems. So despite the vital importance of the financial industry for a modern market economy, it's deeply unpopular. And we think that's a problem. That's a really serious problem. Some people do seek alternatives to the formal financial system. Keeping money under the mattress, informal credit and insurance through social networks, or they may turn to moneylenders and loan sharks, or they may get involved in crypto. We talk about crypto later on in our technology chapter. But this is, the figure here is just showing that this is data from India. You can see we're trying to be very global, but you can see how informal interest rates can be extremely high. There are some low ones at the left, low rates, which is, borrow from your friends and family. But then once you turn to moneylenders and loan sharks, you're in really serious trouble. So we argue that these alternatives are all worse. People are jumping out of the frying pan into the fire. And from a social point of view, we need a formal financial system to allocate capital efficiently. That cannot be done by moneylenders, friends, and family. Okay, now I'm going to speed up. I'm going to have just one slide on each chapter in part 2. I only have limited time here, but we basically, in part 2, we break the financial system into 4 big areas. The first we call managing the ups and downs. That's short-term saving for an emergency fund, short-term borrowing, debt traps, credit cards, all of that kind of stuff. Chapter 5, making large investments. There we group together higher education and housing. Chapter 6, living with risk, is all sort of risky investing stuff, but including insurance, very importantly. So it's investing in insurance. And then chapter 7, securing retirement, that's about life cycle saving and investing. So managing the ups and downs, just one slide on each of these. We talk about the volatile income and limited savings that many people have. The figure is the fraction of households in each of a number of countries who have less than 3 months of average consumption available in a liquid asset form. That's about 40% in the US, a bit over 50% in the UK. It's better in Germany and worse in emerging markets. Then we talk about various challenges. How do you keep your emergency funds safe while also earning a reasonable interest rate? How can you arrange short-term borrowing ahead of time so you don't pay an extraordinarily high interest rate? And if you do get into debt, how do you pay it off? People ignore the problem. They don't pay off high APR debt first. They may end up paying high fees to debt consolidators, et cetera, et cetera. So that's what that chapter is about. Chapter 5 is about, as I said, higher education and housing, which we put together because they're both large, lumpy investments with high returns on average that people have to finance. Of course, educational debt is unsecured and mortgages are secured, but all the same, they can be treated in parallel. And we talk about how complex it is to understand both the cost and the return of higher education. There's a distribution of educational returns in that figure to the right. How difficult it is for people in this country to choose a student loan repayment plan and get income contingent repayment if they need it. The Biden administration has been working on that. Then we talk about the difficulties of choosing a mortgage, some of the things we were talking about this morning. Fixed rate mortgages, adjustable rate mortgages, points, which are a weird US system that makes things even harder. What is the role of IO mortgages? And how should you refinance a mortgage? And then, of course, how should you pay it off? Chapter 6, living with risk. Now here we take a crack at explaining expected utility theory in words and using it seriously. So fools rush in where angels fear to tread. Most financial advisors would not even attempt this. But we use expected utility theory to try to explain the principle of participation, that you should, if you have a positive expected return risky opportunity, no matter how risk averse you are, you should take some of it, unless fixed costs kill the argument. The sort of concept of the Merton portfolio share, again, conceptually, the idea that diversification raises the Sharpe ratio, and the idea that given that insurance in practice has markups, it's not actuarially fair, how much should you buy? Well, that's going to depend on the markup, the scale of the loss, and so forth. So we use that to explain ideas like the merits of high deductible insurance, not buying extended warranties on washing machines, things like that. And then other familiar ideas in the chapter: market efficiency, mean reversion in stock returns, and in the insurance context, adverse selection and moral hazard. The figure at the right here is a figure from the chapter which shows evidence from the survey of consumer finances on the participation rate in various asset classes among households, the lowest asset households at the left, the highest asset households at the right. And the key line is the yellow dashed line, which is the public equity participation rate, which of course rises with wealth, but surprisingly slowly. So that's the limited participation puzzle, which is still there, although less so than it used to be. And then chapter 7, securing retirement. The context here is, of course, an aging world population, which stresses pay-as-you-go retirement systems. The figure at the top there is a growing and flattening world population age pyramid over the recent decades. The decline of family support for older people, the shift from DB to DC retirement plans, and an environment of low real interest rates. And then we focus in this chapter primarily on US data, that saving seems too low on average. The retirement adequacy looks much better in years of high house prices and stock prices than in other years, but too low on average. And people are often confused about their retirement prospects. So there's interesting research from the Boston College Center for Retirement Research, Alicia Manel and her colleagues, showing that there's a large group of people who actually are fine, who are very worried, and then there's another large group who should be worried and aren't. And there's all kinds of reasons for that. People don't know how to think about housing equity, they don't understand the rules for Social Security benefit payments, and so forth. We also talk about what you do after retirement, the reluctance to annuitize, and the phenomenon of seniors who are house rich and cash poor, who have, if you like, trapped housing equity. Okay, so I've gone through that super fast because I know very limited time, and I want to spend the rest of the time, if we could get the slides back, the rest of the time on how to think about a solution. So chapter 8 is about what technology can contribute. We argue that it certainly can help, but it also can be dangerous, and it's not enough by itself. Chapter 9 is called Shove, which is a response to the famous book Nudge. Basically say, no, nudging is not enough. You have to be more aggressive than that. And then chapter 10, we can do better. Okay, so chapter 8, what's technology doing? You know, the figure there is a rate of mobile phone penetration, the number of mobile phone prescriptions per 100 people, which is above 100 today in a lot of countries, and even in surprisingly poor countries. The blue dashed line is Nigeria, and you can see how prevalent mobile phones are, this basic technology around the world. So the promise of with smartphones as the interface and then cloud technology in the background, the promise is lower fixed costs, which of course enables customization and can, in principle, lower search costs by making it easier to compare offers. So think of, fintech mortgage lenders, robo-advisors, small dollar app credit, even paycheck advance schemes, which are made possible by the technology in the background that makes it affordable for employers to offer these things. So we write with some enthusiasm about these developments, but then we highlight the perils, targeting weaknesses, for example, gamified stock trading, which came up this morning, or an example I like from China, there's a paper by Jun Pan, which shows how mutual funds are listed on the Alipay interface on Chinese smartphones. They're listed in order of their 1-year return. So at the top of the screen, the highest return in the past year, and then you go down from there, and guess which funds people buy. Second peril is price discrimination using personal data. In other words, use the technology to identify the people with the highest search costs and then offer them high prices, right? There's the possibility of doing an end run around regulation. We know that, decentralized finance institutions like FTX were essentially, unregulated in all kinds of ways. Or just think of the technology that allows large deposits to be split into smaller chunks that fall beneath the deposit insurance ceiling. So now I can have a multi-million-dollar account and I can get deposit insurance on it. And then finally, algorithmic discrimination in credit allocation. So, we talk a little bit about how we could get the good while, realize the promise while controlling the peril. We argue that what's sometimes called regulatory sandboxes can be helpful, where you allow novel things to be tried out on a small scale. You look at them carefully, and then you allow them to scale up. We make a pretty basic, but I think sensible point that technology that's automating simple processes is probably safer than solving a very complex optimization problem. You certainly want to monitor cases where consumer psychology is being manipulated. You need to think hard about data privacy standards. The consent approach may not really work, right? We all click, I agree, all too easily. We have a quote in the book from Richard Posner, who said, when he was getting a home equity loan, he said, "I didn't read, I just signed." And that was Richard Posner, all right? So we think that it may be necessary to move to statutory rights for data subjects. In other words, it doesn't matter whether you consent, you have certain rights that can be legally enforced. It's also going to be important to provide funding to help the late adopters, so you don't get people in the older generation and less educated people who are stranded because they no longer have any interface that they know how to use. And then finally, we have a section of the chapter where we beat up on cryptocurrencies. We come out with just anti-crypto, basically. So I'm not going to get bogged down in that argument. All right, so chapter 9, shove. All right, so this is the chapter where we say, is there a role for government? What role can government play? And I think this morning Jonathan Parker said about somebody, you're awfully optimistic about the potential for regulation. How naive are you? Well, we're being regulatory optimists here, and we may be naive, but that's what we're doing. Now, we do step back and we say, look, what role should government play? Let's start from the basics. Let's not forget the basics. So financial infrastructure is important. Things like digital IDs, the payment system, ownership registries, and so on. And actually, in this country, advanced as it is, some of these very basic things are amazingly primitive, right? You know, Estonia is way ahead of the US. But you know, even India is ahead of the US in terms of the ID system. And you know, the notion that every time you buy a house, you have to buy title insurance, that's only exists because we don't have a proper ownership registry. We have a very archaic system. Financial education is also a basic, but as I've argued, that's only a partial solution. And then we talk about channeling the flow of information. Of course, the first tool that any consumer regulator thinks about is disclosures. And we say that can be helpful, but you know, only up to a point. The design is key. You have to express disclosures in units that people understand. Ever since the Truth in Lending Act, almost 60 years ago now, the regulatory ideal has been to disclose the cost of credit in percent per year, the APR. That we all think that's great, but actually ordinary people struggle to understand those numbers, I think. So we make the case that it's also helpful to, while APR is helpful, it's also helpful to try to put costs in dollar terms under certain standard scenarios about usage. Another problem with disclosures is that if you have to input too much information, people won't do it. So college cost calculators are very burdensome for people to use. You have to put in information from your tax returns. So Phil Levine has both a proposal in a book, and actually he's created a simpler, approximate college cost calculator that's much easier to use. So things like that are really important. And then the other aspect of this is quality control. So if you look at who's complaining to the CFPB, they have a consumer complaint database. And the bar chart there is showing the number of complaints, which are just rocketing upwards. And the pale blue is the complaints about credit reports. So the big thing that people complain about is this thing got on my credit report and it's wrong and I can't correct it. So I think quality control is actually important. Because of course, correcting errors is very valuable to consumers. It's costly for the credit agencies and the banks. They may not want to do it unless there's a mechanism to force them to do it, and there's really no mechanism for consumers to pay up to get the errors corrected, even if it's a very valuable thing. Then, you know, nudge, question mark. We write a sort of short critique of the nudge approach based on the recent literature. We distinguish between suggestions and defaults. So as an example of a suggestion would be the Card Act adding to the monthly credit card statement the information about what will happen if you pay off your debt in 3 years and how much you have to do that. And it has a statistically detectable effect, but it has not overall altered the amount of credit card debt that people have outstanding. There's a more recent study in the UK of a more aggressive suggestion that reached similar conclusions. Defaults, of course, work better, and there were the early, very promising results on 401k plan enrollment. But there are problems. One which has been known from the beginning is that if you have a weak default, in other words, a low default savings rate, that can have a perverse effect of lowering the savings of some people who would otherwise have saved more. Whereas if you have a strong default, that will tend to trigger opt-outs. So it's hard to find the sweet spot. What's happened more recently is research has discovered that default effects seem to wear off over time. So David Laibson has some recent work on this with colleagues. And then in many contexts, perhaps not retirement saving, but many other contexts, there's the problem of counter-nudging. So for example, you have to opt in to so-called overdraft protection. The default by regulation is no overdraft protection. But when you open a bank account, the nice person on the other side of the counter or the desk is saying, oh, you'll want that, check this box. And people do. So that's counter-nudging. So, we say you need to be more aggressive. And we think that's going to need a single consumer financial protection agency. In this country, the CFPB was created with that in mind. In the UK, you have the Financial Conduct Authority. But there are other countries that lack a single body. We point out that these bodies often are very reluctant to call out financial problems, and certainly reluctant to name and shame particular financial product providers. For political reasons, they're reluctant to do this, but it's actually important. And in the UK, the FCA has come under a lot of criticism for their sort of sweeping problems under the rug behavior. And then, of course, what are the tools to actually change things? Well, you've got to change prices through taxes or subsidies or even price caps by altering the costs to providers. For example, you can give safe harbor from litigation. That's one strategy. And possibly regulating product access. All right, so that's all rather abstract. What should you shove? What more concretely should you do? Four areas of focus we suggest. One is fight biases with biases. So for example, create savings accounts that are aligned with people's mental accounts, an educational savings account, for example, or prize-linked savings, which is a topic that's come up. Try to exploit the popularity of gambling by linking it with a savings product. Second approach is to curb market power, require standardized product offers, and also regulate the units in which prices are quoted to make sure they're comparable and comprehensible. Clamp down on conflicts of interest. So we support fiduciary duty for financial advisors. And then finally, try to automate financial decisions. So, this is a world in which engineers are working on self-driving cars. So we should have self-driving financial products. Self-refinancing mortgages. Target date funds are semi-automated. They respond to age, but they don't respond to other things like the balance that's already been accumulated, whereas the theory suggests they should do that. So there's a number of areas where I think asking people to do less financial decision making is the way to go. But we don't want to come over as sort of naive leftists who just want to shut down the financial industry. So we do make two cautionary points. One is we think that it's a mistake to, in effect, impose fiduciary duty on the whole financial sector. That's actually what the FCA in the UK has come awfully close to that by promulgating what's called the consumer duty, which is very vague and basically says you have to act in the interest of your customers, and we'll tell you after the fact whether you did that or not, and we'll come after you if we say you violated the duty. Well, what's that going to do? It's certainly going to choke off innovation, and it's going to lead to very cautious behavior, and I think overall raise costs. So, we don't favor that. We also think that in today's world, the provision of financial services is a big technology project. And the record of big government technology projects is very poor. Think of healthcare.gov, the rollout of that, the revision of the FAFSA form last year. I just read an article about the Treasury Direct Treasury website for holding Treasury bonds, which works well in many ways. But if you want to transfer your Treasury bonds to your brokerage account, that can take up to a year, apparently. And in the UK, there's a huge scandal going on called Post Office Horizon, which dates back to an accounting software that the British Post Office bought from Fujitsu, and it was faulty, and it falsely signaled fraud and embezzlement by a large number of small, people running post offices, rural post offices, who were then taken to court, fined. There was at least one suicide, and it was all a big mistake. So, it's easy to be romantic about the old days of postal savings and so forth, but I think if you look at Post Office Horizon, it's hard to be very optimistic about that. And we do talk a little bit about nonprofit and mutual financial institutions. There are some wonderful examples there, like Vanguard is one. But these types of organizations struggle to scale up, and they often abandon their original mandates. So credit unions, for example, tend to have fairly high income customers at this point. It's not like they're really directly reducing inequality. So we think, we need a privately organized, shareholder-owned financial industry, but it needs regulation. All right, so what about details? And I know I'm running out of time, but the last chapter is trying to sketch out what things should look at. The key idea is that instead of a vague consumer duty, consumer financial regulators need to specify upfront, with help from people like those of us in this room, specify upfront what good financial products look like, good, simple financial products, and try to make sure that people have access to at least basic financial products in the form, we call it a personal finance starter kit. If you're going to play a sport, you need pads, cleats, helmets, bats, depending on the sport. And these things need to be made available, and they have to be mandated. So the idea would be, in each category of financial products, the firms that are active in that category must offer starter kit products, although of course they can offer other products as well. But these products have to be offered, and they have to have standardized designs with price structures that facilitate comparison shopping and that are easy to manage after purchase. Now, in a few cases, you might go further, and you might actually require people to buy those products. In other words, go beyond mandatory to offer to actually mandatory to choose. That's obviously much more challenging politically, and should only be done in the most important cases. But the overall idea is keep it simple, keep it cheap, keep it safe, keep it easy to use. I know those principles sound like 4 of the 7 dwarfs, but anyway, that's what we're trying to have in the back of our minds. So then we go through, and I'm not going to have time to, I'm going to run out of time, but we follow the same structure as part 2. So we have product starter kits, products for managing the ups and downs, simple transaction accounts. We talk about what the fee structure might be, savings accounts, lines of credit. Then we talk about starter kit products for making large investments. Educational loans, we argue that income contingent repayment should be the default. Simple mortgages. We don't take a stand on ARM versus firm. That varies a lot across countries, and there are many, many sort of systemic arguments either way. But if they're ARM, they shouldn't have teaser rates. If they're firm, they shouldn't have points. We make the case for ratchet or self-refinancing mortgages, where the refinance thresholds and any fees chargeable at these times can be set to avoid driving up mortgage rates ex ante. We talk about the lock-in problem, which can be handled with some combination of assumability and portability. And we argue that while many countries strictly regulate IO mortgages, we argue on life cycle grounds that they can be advantageous both for younger and older borrowers who are not in the intense saving period of their lives. We talk about living with risk. index funds with fee caps. Structured products are popular in Europe and Asia, beginning to come in this country. They're notorious for their opacity and high fees, but we argue that if the form is simple enough, they can help to increase participation in risky markets by people who otherwise would not dare to participate. There's some evidence on that from Scandinavia. We talk about short-term insurance and long-term insurance. We suggest that long-term insurance policies, such as life insurance policies, should have gradually increasing premium paths to mitigate this lapsing problem that the lapsers cross-subsidize the stayers. And then retirement. Really the key here, I think, is to have a single retirement account that people can carry with them, with automatic enrollment at the date of first employment. We make the case that a Roth structure is preferable to traditional, both because it makes it easier for people to understand how much money they have saved already for retirement, because they don't have to downweight their retirement assets by the tax burden of withdrawal. It reduces the asset management fees that the government implicitly ends up paying, and it makes liquidity withdrawals easier to manage when you have Roth. We suggest that contributors with low balances should receive a government match. We like John Friedman's suggestion that some of the money that's used to provide tax incentives to savers might better go to employers to reward them for enrolling employees. And we suggest that withdrawals for emergencies should be structured as amortizing loans. Then we talk about target date funds, deferred payout annuities, and ways to help seniors extract home equity through standardized reverse mortgages. And a very simple version of that is property tax deferral options. Okay, I'm almost out of time. I want to emphasize, we're not trying to nationalize the financial system or choke off innovation. People should certainly be able to move beyond this starter kit on the basis of, just the beginnings of participation in these simple products and demonstrated financial knowledge. Well, is all of that pie in the sky? What's realistic, really? Well, elections matter. We have one coming up. That's going to make a huge difference, potentially, to what might matter. But then looking globally, different countries are different. The economic fundamentals vary, tax systems, DB pension provision. It's just a different retirement story in a country with generous public DB pensions, like France, for example, than one like Australia that relies almost entirely on DC. We have bank-dependent versus market-oriented financial systems, and the cultural attitudes to personal finance and the role of government vary wildly across countries. So we don't want to come over as saying that there's one system fits all. We, the economists, can just write down the financial system everybody should adopt. But we do think the problems that we've talked about in this book of personal finance are serious enough that they undermine support for capitalism itself. I mean, I'd make an analogy with the loss of faith in free trade, in the wake of the China shock. And the fact that the Republican Party has abandoned free trade is really a symptom of a very serious problem. And I think these financial problems, personal finance problems, are dangerous to neglect. So the goal of the book has been to aim to raise awareness of how these problems are common around the world, and hopefully the benefits of carrying best practices across borders. So let me stop there.